All right. Today is Monday, the 15th of January. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. Happy MLK Day. Hope you're enjoying the weekend, although I have a feeling that you have one of those chilly bones. Why? Because we have this polar vortex bomb cyclone, whatever, and it's cold outside. Freezing cold. Where are the cow farts when you need them to make that global warming happen? Anyhow, how bad is it, Maverick? Here's how bad. We got over 1,000 flights canceled at the Chicago airport, one of the major hubs in this country. How bad is it, Maverick? In the city of Houston, Texas, the lows today will be 23 degrees.
Damn, that's cold.
And in my former hometown of Portland, the lows would be at 17 degrees tonight.
Oh, so cold.
And if you thought that was bad, here's the Big D, Dallas, Texas, at 14 degrees at night. And if you thought that was bad, here's Chicago for you, -4, the lows for tonight.
Oh, madon.
And of course, since we're going to talk about the Fed, here's Jackson Hole, Wyoming for you. We know it's cold, but not this cold, -18 tonight, with an avalanche warning.
Now it sounds like they're going to have one hell of a night.
What else do we have tonight? We have the Iowa caucus, and I got a wild prediction for you. I think that former President Trump will win. I'm not sure, though. It could be a close call. But in reality, it's going to be who's going to have the higher heel tonight, Nikki Haley or Ron DeSantis. One of these two will say goodbye. So we'll see what happens, folks, but I hope you enjoyed the wild card football weekend. And I gotta congratulate anybody from the city of Detroit. It's been a while. You beat the LA Rams, and you're in the postseason for the first time since 1990, I believe. So congratulations to any viewers from Detroit. I know a lot of folks were crying last night. Could not believe it. But it's about time the city of Detroit breaks records other than the rate of homicide in the country. And look, if I had to bet here, I think that the Buffalo Bills are into something here. They just beat the Steelers. And I say it doesn't matter, the Buffalo Bills or anybody. Just please, I don't want Kansas City to win the Super Bowl this year. I'm sick of Taylor Swift. I think I got Taylor Swift fatigue. Just time for her to disappear and make her miss her a little bit. Because now the entirety of the nation, with the exception of Kansas City, of course, rooting for the Chiefs to lose. But see, the thing with Kansas City is they're getting really cocky at this point. They've been having it so good, and they think that nothing's going to stop them. I say watch out, because getting cocky, that's how we're going to get eliminated. And speaking of getting cocky, how about the Bulls? Not in football, the Bulls in the stock market. They're getting too cocky now. See, last year we got the mega cap stocks lifting the stock market higher. We got a little bit of an AI mania sprinkled with the end of the year rate cut optimism, and the stock market is back where it was in 2021. And now they think that nothing is going to stop them. But folks, this week we got a warning. Just a little taste of what's about to come here. See, in this channel, we've been talking about the duality of the risk. You got the propagandists, the CNBC, Janet Yellen, Jim Cramer, Jerome Powell, all saying, oh, we got a soft landing. It's over. It's done. Soft landing, everything is great. The economy is going to be better than ever before, and stock market will go back to the moon. What they don't realize is this is the most critical period of any economy. When you're done hiking rates and you begin to see the rate of inflation going down, you begin to see the light at the end of the tunnel. That okay, it's over. Inflation is gone, but the economy is still holding. The Goldilocks, baby. The light at the end of the tunnel is right here. The problem, of course, is the light at the end of the tunnel could be a train coming at 300 miles per hour. And that is, of course, if the Fed declares victory prematurely. What they're going to lead to is reinflation. Inflation will come back. Now, if they decide to keep rates as it is because they want to make sure that inflation is going to go down to 2%, then that's going to amplify the risk of recession in the economy, hence the duality of the risk. And now, all of a sudden, not just JP Morgan Chase CEO Jamie Dimon, who caught up to the reality of the duality of the risk, the media beginning to talk about it now. The Fed is talking about it now, that there is a balancing act here. Cutting rates too soon, that's going to give you reinflation. Waiting too long, that's going to give you a recession. Do you realize how hard it is and pretty much impossible to get a soft landing? This is why it never happened before. Example of the reinflation risk. Here's the headline for you. Housing. Bidding wars erupt as 2024 kicks off, with some listings seeing over 30 offers. Here we go. We're back to the bidding wars and the cash offers because mortgage rates went down. This illustrates for you the risk of the Fed, of course, declaring victory too soon and saying, okay, let's cut rates. You're going to see the resumption of the mania and reinflation in the economy. What about the other risk, though? The recession risk. Here it is. This week we got Delta Airlines earnings, and To be honest with you, the quarter was pretty good. And we said in this program before, if the conversation is about the quarter that was, then airline stocks will do pretty good because last quarter was phenomenal. If the conversation becomes about the guidance, what's about to come, then these airliners will go down. And unfortunately for them, of course, we got the flying coffin, Boeing with the door blowing off midair and Alaska Airlines. And on top of that, Delta Airlines comes out and says, oh, watch out. Maybe we've done pretty good here in Q4, but from this point on, it's not going to be pretty good. So we're going to lower the 24 earnings guidance. Well, gee, why would that happen? It's not because fuel costs are going higher, energy costs are actually down. It's because of consumer weakness. They lose the pricing power because the consumer is getting weaker. They cannot afford the insane pricing on tickets anymore. And of course, if the margins go down little by little, the airlines will begin getting rid of employees. We see the unemployment rate moving higher in the economy. Even the affluent consumer. We got plenty of warnings here. Burberry comes out and says, watch out, profits are going down. Why? The consumer is not spending anymore. Now you might say that Burberry sucks and all of that, but we see this in many luxury brands. You look at the prices of Rolex watches, you look at Gucci sales, all down. Well, the rich still have money they can spend if they want to, but they choose not. They're being conservative because they know what's about to happen to the economy. Friday, we got banks earnings. When we talk about the duality of the risk and the risk of a recession, here it is. Citigroup is now cutting 10% of the workforce, almost 20,000 jobs. Why? The numbers don't look good. They need to reduce cost. And this is going to happen not just in banks, but many companies. So if you think that the economy is out of the woods, watch out. See, the economy and the stock market, relatively, they do pretty well. When the Fed is hiking rates, when the Fed pauses interest rate hikes, but then we get to a point where, okay, which one is it going to be? If we go back to the example of the GFC, 2006 to 2008, well, the Fed began to see recession signs in the economy, beginning in the housing market. They decided to cut rates. Next thing you know, oil prices spiked higher. So we got the duality of the risk. Inflation in energy prices, and then you got recession risk coming from the housing market and the banking sector. And eventually, of course, something got to give, and we got the collapse of Lehman and goodnight Irene. And the same thing will happen again here, absent of a miracle. The Federal Reserve would not cut rates absent of a disaster hitting the economy because cutting rates too soon guarantees the resumption of inflation. Even Mohamed El-Arian, who I thought already capitulated and said, yeah, well, we have a soft landing now. I don't know. Let me know in the comments what do you think. Do you think he capitulated or not? Maybe I'm just being too hard on him here. But now he says inflation is stuck and the Fed cannot lower prices without damaging the economy. Duh. This is what we've been talking about here. So, of course, we hear from the zombies in central banks. For example, Atlanta Fed Bostic comes out and says, warns actually, that U.S. progress on inflation is likely to slow. In other words, you gotta taper your expectations here about rate cuts. Across the Atlantic, Madame Lagarde comes out, says rate cuts to occur if it is clear that inflation has fallen to 2%. Today we get the headline from the ECB again, possible there will be no rate cuts this year, says an ECB member. Because, ladies and gentlemen, rate cuts only happen for the wrong reasons. And I know what you're going to say. You're going to say, well, what about 2018 when the Fed cut rates and then we lived happily ever after until the crash of 2020? Why did the Fed cut rates, or at least Jerome Powell abandoned his autopilot hiking policy in 2018? Because the market crashed by 20%. Rate cuts only happen for the wrong reasons after the disaster. And this week we got a reminder. The CPI came out, and guess what? It went higher month on month, as you can see here. December, we were supposed to see CPI going down negative if we were about to cut rates for the good reasons. But we see that inflation coming back up again. You look at the CPI, all items in blue. Doesn't look like this is going down for me. It looks like it's bottoming right now. It's about to perk up higher. There's too much risk that if the Fed indeed cuts rates in March, as the market is anticipating, and rallying equities prices based upon, if the Fed does that, inflation will come back and then we go back to 0.0. Now the Fed has to flip and do 180 and take the rate cuts off the table and do a hike again. You can't do that. Too much risk. And the Fed realizes that. And this is why Atlanta Fed Bostic comes out and says, watch out. Even though he's one of the biggest propagandists and so-called doves in the Federal Reserve. Insider trader, of course. The other narrative that you hear is, oh, but Maverick, if you look at the 3-month inflation, the average is already below 2% if we look at the overall inflation rate. And that means that sooner than later, inflation is going to go down and the Fed is going to cut rates by March. And you're just being a doom and gloom here. fearmonger. All I got to say is look at the core inflation rate. In the past 3 months, over 3%. 6 months, over 3%. Past year, over 3%, almost 4%. That is way above the Fed's 2% target. As far as the overall rate, that is all done because of the drop in energy prices. We know how volatile energy prices can be. Just look at what's going on in the geopolitics. The Red Sea, the Middle East. Energy prices can come back up easily. We see that overall inflation in the 3-month trend going back above 2% again. If we look at the CPI report year on year per category, we can see that shelter inflation is up by 6.2%. And I remember that the propagandists and the pumpers, as far back as 22, they've been saying, oh, but the CPI is lagging. It's all about shelter inflation now. And if you look at apartments.com, the prices are going down, that's going to show up in the CPI. Well, it's been about 2 years now, and it never really showed up. Shelter inflation keeps going higher. Why? Because this narrative is bullshit. They don't understand how shelter inflation is calculated in the CPI. But regardless, we see that electricity costs up 3.3% year on year, food up 2.7%, vehicles up 1%, apparel up 1%. What went down year on year? Medical care services down about 0.5 percentage point, but month on month they went higher. Gasoline, here it is. Gasoline down 1.9%. Why is that happening? The oversupply that we see right now, OPEC could take care of that. And then we have the risk of geopolitics, so we could see gasoline coming back up again. And then all of this narrative about inflation going down, poof, gone. And with that, all of the hopes for rate cuts, poof, gone. Just think about what's going to happen with goods inflation as we see container shipping rates skyrocketing because of the crisis in the Red Sea. This is a massive, massive surge. Prices almost doubled in a couple of weeks now. And I don't see that the crisis will be resolved anytime soon. It appears that maybe we're going to go, or let's say, to be honest, dragged into a war here. What do you think that's going to do to oil prices? The fight against inflation is not over yet, not even close. And any move by the Fed to cut rates will be a major, major mistake. It will take us back to the crisis from the 70s. So when will the Fed really cut rates? The answer is, will we have a recession risk or a recession fear episode? That comes, for example, from a systemic risk fear, something blowing up in the economy. Then the Fed begins talking about interest rate cuts. Where do we see the systemic risk brewing in the economy right now? The answer is the banking sector, of course. It's always the banking sector. But this time around, it's real estate, not homes, not single-family homes as it was back during the GFC. It's other real estate, offices, hotels, healthcare REITs, multi-family residential REITs. Those are the ones at the risk of blowing up. We begin with office REITs. What happened in the pandemic? Everybody stayed at home. We've been doing our jobs from home. And for the most part, it's been working out. No reduction in productivity. Productivity actually went higher. Folks appear to be more happy staying at home, working from home, staying with their families, taking care of the kids. And that's not going to change anytime soon. What does that do to offices in the country? Think pre-pandemic. You have all of these companies, investors, who took a massive amount of loans with expectations that we're going to see massive expansion in the economy. They took the loans, they built all of these nice buildings with offices, bought buildings, and then came the pandemic. And we haven't seen a recovery yet. Vacancy rates continue to go higher. Well, at some point, if you're not generating enough revenue from this investment, from rent, how are you going to pay the mortgage that you took to buy the office building? Furthermore, what happens when it comes the time to refinance this loan and this debt? At a higher rate, of course, because rates went significantly higher. Not just the investor who took the loan to buy this nice office building who's on the hook. It's also the bank. Because if the investor fails to pay the debt back, they're at the risk of foreclosure. Who do you think will eat the bag here? It's the banks. And this is how the systemic risk happens in the economy. I don't know if you caught 60 Minutes last night, so I'm going to show you the segment here, at least brief snippets from the segment. I can't show you the whole video because the babies at CBS will cry, even though I'm trying to help them here. But listen to how things are about to spiral out of control. Take a listen.
So commercial real estate is a huge part of the book of business of your typical bank. And I'm talking mostly about these smaller and medium-sized, maybe regional banks. They have a lot of exposure. That is their bread and butter activity. About 30% of all their loans are commercial real estate loans. And here we are sort of seeing weakness in office that is something like that we have never seen before. And banks need to come to grips with that.
Are you comfortable calling this a crisis?
I think we're at the beginning. There's a potential crisis here.
In December, nationwide office loan delinquency rates crowded 6%, almost 4 times what they were a year ago.
A downturn in real estate made worse by bad loans, contaminating banks, and potentially the entire economy. Echoes of the global financial crisis of 2008 are hard to ignore. But whether the trouble with office buildings ends in a simple pricing correction or becomes a systemic crisis, likely there's pain coming, not just for building owners and banks, but for cities themselves.
In the long run, property taxes on those buildings will also fall by 40%. And these commercial property tax revenues are an important component of the budget of local governments, which means less money for police departments, trash collection, and some people are going to decide that, the quality of life has deteriorated too much and they want out. And in fact, that's what we've seen. In the last 3 years, our largest 10 cities have lost about 2 million residents.
You're losing that tax base as well.
And now you're losing that tax base. And now this cycle continues.
So you heard what they said over there. Okay, so if the office is going to go bust, the banks will eat the bag. It doesn't just stop there. The city, in this case, New York, but we also have the same problem in LA and San Francisco. So be it New York, be it California, all of these states will begin to lose a lot of revenue, a lot of tax revenue. We already see the state of California, for example, in a massive, massive budget deficit. How do you think that will be resolved if you're not generating enough tax revenue because offices went bust and banks are blowing up? Then you have the best taxpayers leaving these cities and these states. We're talking about states here, big states that could be in massive trouble. California, New York, Illinois, Washington, Seattle. Now, the solution, if you watch the entire segment in 60 minutes, they say, these office buildings will be converted into residential units. And that's going to solve the problem. Not even close. That would actually be the nail in the coffin for this whole shebang. The headline from Bloomberg reads, short sellers see distress emerging in apartments as borrowing costs surge. What are they talking about? Here it is. And pay attention now. This is really important. Soaring rents and cheap funding made blocks of U.S. rental apartments seems like a, quote, can't miss, end quote, investment during the pandemic. Developers piled in to take advantage by constructing millions of the multi-family units, while investors snapped up older complexes to renovate them. Since then, borrowing costs have surged, and now there are emerging signs that some borrowers will struggle to refinance. Fitch Ratings said on Thursday, rents are stabilizing, landlords' expenses have risen, and competition has grown, which will cause the delinquency rate for assets to double this year to 1.3%, exceeding the pandemic peak, according to Fitch. And look at this. The delinquency rate for multi-family housing is now at the highest level since the financial crisis. And ladies and gentlemen, we're talking about $1 trillion of multi-family linked debt, which will mature by 2028. All of this debt will have to be refinanced at a higher rate, absent, of course, of something blowing up and rates going down to zero. Then we have no problem, but probably at that point, a lot of these multifamily units and their investors went bust, along with the banks that lent them the money. The warnings come as more than $1 trillion of multifamily debt is due to mature through 2028, according to data compiled by TRIP, potentially leading to increased defaults and losses for banks and bondholders. While the problems are not seen as systemic, short sellers are moving in to try to profit from the emerging distress. Daniel McNamara, the founder of hedge fund Polopo Capital, I believe, says I expect a great deal of pain in multifamily as we adjust to a higher interest rate environment, along with a lot more supply hitting the market in 24. And folks, it's already happening. The residential property value for multifamily apartments is moving down in a big way. In other words, if you bought units between the years of 21 and 22, you're sitting underwater. Question now becomes, can you continue to generate enough rent to pay your debt? And what happens when you have to refinance at a higher rate? Meanwhile, the value of the property went down. We're not seeing the problem here in single-family homes. We'll talk about that in a minute. But multifamily, that's a ticking bomb, along with offices, that is about to be detonated in this economy. When we look at the supply of apartments, huge wave of supply is about to come. So it's not only that the values went down because of interest rates going higher. The supply will amplify the drop in these values. And this is why when we look at the debt, when we look at potential distress in apartments, that is worth about $67 billion that could be in distress right now. The obligation for the investors, the banks, things could spiral out of control in this economy. And all in all, in the real estate sector, we have about a little over $200 billion worth of debt in potential distress. If you think that this is not a ticking time bomb, I got a bridge to sell you here. Now, when it comes to single-family homes, We know that investors been scooping homes during the pandemic like never before, turning this nation into a nation of renters, and by doing so, killing the American dream. The good news is, it could also blow up really soon. We know that they've overpaid for these homes. The thing is, the pricing of homes did not go down as we see with apartments and multifamily units. So for now, they're holding, but they know that the avalanche is coming. To begin with, higher interest rates made the monthly mortgage cost really high. The share of the monthly mortgage cost as a share of the median household income is now exceeding 40%. It's insane. So we're seeing that the housing market, of course, slowing down. That did not result in housing prices going down. So for now, all of these investors are doing okay. And with expectations of rate cuts, as we've seen earlier in the segment, we might see a resumption of the mania and the cash offers. We might see pricing going higher a little bit. But if something blows up in the economy and we begin to see those buyers actually pulling back and being afraid that we could see a crisis here, they could lose their jobs and no longer afford the mortgage even though it went down from 8% to 6.5%, maybe 5%. Then at some point, we will see single-family home pricing also going down. A lot of these investors going underwater along with their creditors, the banks, and the rest. They will end up holding the bag. If we connect the conversation together, if we see a huge supply of apartments coming, which will devalue the market and cause a lot of distress, we see that it's really worth it to rent right now, not to buy a new home. And if renting becomes more attractive, then at some point, the buyers will stop stampeding or lining up to buy single-family homes. And that's going to drop the value of single-family homes. That's going to be another crisis. So right now we have the distress in offices and multifamily. And soon enough it could come to single-family homes. And the supply is creeping up little by little. You can see the starts, the permits moving higher because home builders know that we have a shortage of supply. The resolution is to dump more supply in the market, and that's going to reduce prices down. The problem is, what if we have also a recession in the economy? And we see the unemployment rate moving higher. Then single-family homes will have a double whammy. That is the increase of supply and the weakening economy, aka the loss in demand. So pricing could come down crashing. Now you have a lot of not just investors, you have a lot of homeowners who are sitting at homes that they bought in 21 and 22, perhaps 23, and the value of these homes are now underwater. That's the risk of deflation. A lot of folks think that deflation is good for the economy. It's good for the consumers and those who've been really conservative and planning for an economic downturn, because we can go ahead and scoop these assets for pennies on the dollar. But ladies and gentlemen, deflation actually means recession, because deflation means that a lot of assets were bought at a certain price, a lot of debt was incurred at a certain price, and now those prices are going down. A lot of investors, a lot of lenders will be underwater. Deflation equals recession. Recession equals deflation. If you want to see a glimpse of what the upcoming crisis in real estate would look like, here it is. We've seen it already in hospital REITs. The headline from the Wall Street Journal reads, "Nation's biggest hospital landlord suffers new losses." You might have noticed that the stock of MPT, Medical Property Trust, crashed by over 30%. Well, gee, why did that happen? Here it is. Medical Property Trust, the country's largest hospital landlord, said that it would record about $350 million of write-downs related to its largest tenant, which had fallen behind on its rent and hired a well-known restructuring advisor. MPT, the ticker MPW, which has long supported Dallas-based Steward healthcare system, said more write-downs are possible. The news released Thursday after the market closed sent shares of MPT down nearly 30% in early trading Friday. The stock is down by 70% over the past year. MPT said Steward was $50 million behind its rent at year-end. MPT said it had agreed to fund a new $60 million loan to Steward and to defer portions of rent owed for 24. Well, that means that Medical Property Trust is eating the shit bag. And of course, the lenders of MPT will soon enough also eat from the same bag. Now listen to this. This is really important. And you're going to connect the themes together here, folks. MPT grew quickly during the years of ultra-low interest rates. The Birmingham, Alabama-based real estate investment trust made a $23 billion worth of acquisition over the 2 decades, mainly hospital properties. MPT buys the bricks and mortar and leases the buildings back to hospital operators. Now, with interest rates higher and money tighter, MPT has been shrinking. MPT has been extending financial support to some of its most troubled tenants, including Steward and Los Angeles-based Prospect Medical Holdings. Steward accounted for $3.8 billion, or almost 20%, of MPT's assets as of September 30, and it is MPT's largest tenant. Prospects accounted for $1.7 billion, or 9% of MPT's assets earlier this year. MPT slashed its quarterly dividend by almost half. So a lot of you who ask me, hey, MPT pays a good dividend. Is it time to buy? I said, look, if you want to buy it, it's up to you, but there was a catch. They have a high dividend because they're under distress. Soon enough, they're not going to be able to pay or maintain the dividend. You see, the problem here, folks, during the pandemic, the government was spending a lot of yayo in the economy, free cash, courtesy of the taxpayer and the future generation of this country, racking up budget deficits by printing trillions and trillions of dollars. And during the pandemic, anybody who had any medical property, hospital, any healthcare service, you can juice up the government for a lot of cash by saying, we take care of COVID patients. So it was easy. Anybody who wanted to operate a hospital got a loan. MPT went on a spending spree. They secured billions and billions of dollars worth of loans from lenders. They bought all of these properties, probably overpaid for them, and then they leased the properties back to hospital operators, medical services operators, and everything was hunky-dory because those operators were able to secure free cash from the government and pay MPT the rent. MPT can pay back the lenders. When you cut that cycle, when you have now, COVID is not a problem anymore, at least not a problem enough to resume the free cash operation by the government. So now these hospitals and medical service facilities, they hired all of these nurses and doctors at top dollar. There was a shortage of these employees. They took loans to buy devices that were also short in supply. They overpaid for them. Now the business went down. It's eerily quiet in these operators. All of a sudden their margins are collapsing. They're not generating enough revenue to pay the costs, so their profits are going down. All of a sudden they can't pay the landlord, MPT. MPT will have problems paying the bank. This is going to happen in offices, folks. This is going to happen in multifamily units and many more. Do you want to see what the risk of deflation looks like? Look no further than the auto loan market right now. We know that the prices or the value of new and used cars, but specifically used cars, plummeted since the highs. So what we see is a phenomenon of negative equity, meaning that you bought a car, a used car, when there was a shortage. The value was way too high. You took a loan to buy the car. Now we see the value of the same car. To begin with, cars, once you drive them off the parking lot, they lose value. But this time around, also because demand went down, supply recovered, so we see that whatever value you paid for the car, now you're sitting deep underwater. Well, what are the ramifications of that? Besides the fact that you, of course, incurred a loan that you have to pay back at probably a really high interest rate on a shitty car that could fall apart or get into a crash. What is the problem here? Here it is from Bloomberg again. It is a big challenge for owners looking to trade in their vehicles for a new one, since they would still be on the hook for the remainder of the loan balance. Plus, your insurance provider will typically only pay out the current market value of the car even if you get in an accident and the car is totaled. If that amount is not enough to pay back the loan, you will have to come up with the rest yourself. Do you think the majority of Americans understand this? Or will they find out the hard way once they get into an accident and the insurance says, whoops, we're not going to pay you the full amount? What do you mean you're not going to pay me the full amount? I'm on the hook for, $25,000. You're saying you're only going to pay me $17,000? How am I going to come up with the rest? $8,000. Do you think most Americans even understand what's going on here? Because when you get into that situation, you'll realize that, oh my God, I also have credit card debt, $6,000, that is now taxed at 21, 22, if not 25% by the credit card company as interest rate. Where do you think the money will come from? It is particularly tough for people who are realizing that they took out a larger car loan that they can afford. Whoops. For instance, say someone borrowed $20,000 on their car and cannot keep up with the payments. They might try to trade in the car, only to find that the vehicle is now worth only $18,000 and they still owe $19,000 on the loan. That means they have to come up with the $1,000 to repay the lender. And again, same phenomenon. When you see deflation, it's not good for the economy. Deflation means disaster. The example you see right here will be replicated in offices, multifamily, single-family homes, across the economy. And banks and lenders will be on the hook too. Look at what's going on with Ally Financial. They wrote all of these loans. Some of them are subprime loans, auto loans. Look at the delinquency rate year on year. 30 days plus, it was about 2% in 22. Now it's almost 2.5%. 60 days plus was almost half a percentage point in the year 22. Now it's 0.67%. When we look at the net charge-off rate, it was 0.85% last year. The whole 24 thing is new, so I'm still assuming they were in 23. But in 22, the net charge-off rate was 0.85%. In 23, it went higher by 1.31%. Is it really surprising, folks, that almost a year into the Silicon Valley bank crisis, and the Fed said, okay, we're going to plug the hole by issuing this lending facility, which will be temporary, by the way. We're just going to give the banks enough money to cover for the exodus of deposits. How temporary is this solution? Because almost a year has passed and banks continue to lend from this facility by the Fed. And now we have over $140 billion that these banks have borrowed from the Fed. Without this facility by the Fed, we would have seen bank after bank after bank blowing up last year. The stock market would have been down 50% last year. But the Fed plugged the hole right now. And the Fed kicked the can down the road because at some point, these banks will have to pay back the Fed. And of course, the Federal Reserve says that this facility will expire in the month of March of this year. How would these banks pay back the Fed when they have all of these problems with delinquencies, with bad loans? Is it really surprising that we see the Federal Reserve net income collapsing down over $100 billion for the first time this century? But of course, this is fine. There's nothing to see here. Everything's okay. We have a soft landing in the economy. The Federal Reserve is in the hole by over $100 billion, and they will never be paid back because these banks will collapse. They will not be able to pay back the Fed. So what's going to happen here? Will the Federal Reserve take over all of these banks and all of these loans? Will we get into a future where we have one bank in the country, and that is the government bank? What are we heading to here exactly, folks? Well, it's certainly not a good future, isn't it? It is no wonder why we see that big corporate bankruptcy filing are up over 100% year on year, the highest level since the pandemic. And again, we talked about the CPI and how that's going to prevent the Federal Reserve from cutting rates, meaning rates will stay higher for longer. So we will see more bankruptcies, more delinquencies, more blow up of banks, and more blow up for zombie companies. That's coming. For example, the share of zombie companies in the Russell 3000 has now exceeded over 30%. At higher rates, with no profits, these companies don't produce any profits. Some don't even have revenues. What do you think will happen to these companies? They're going to blow up. What do you think will happen to retirees? We have these coked up money managers across the country right now, pushing retirement money into the stock market, buying at high valuation, not even considering the risks at all. And all what they care about is the bonuses and commission. They're buying these big cap companies, the mega cap so-called Magnificent Seven, at insane valuations. What happens when these companies go down? They're too big to fail at this point. We're not talking about Apple failing or Microsoft failing. We're talking about the stocks correcting, going down 20, 30, 40%. What do you think will happen to retirees and 401ks in the country, individual accounts? This thing could get out of control. And it could be the biggest one we've ever seen, unless, of course, you lived through the Great Depression. I mean, you got the World Bank coming out saying the global economy is set for its worst half-decade of growth in 30 years. And you know what I see if you've been watching the program for a little bit here. We're going to see all of these fears materializing. We're going to get a crash and a severe recession. And then we're going to sober up for years. All of this QE era will be equalized by a lost decade. In other words, if you are of a certain age, let's say 40 plus or heading into your 40s, what happens when the value of your assets, including stocks, and your retirement blows up and it goes down 40, 50%? You're going to spend the rest of your life chasing it just to get back to even. And this is why when you have the arrogance and the cocky behavior by folks, oh, the perma-bears are wrong, or you're just paranoid, you're doom and gloom, everything is going to be fine, stocks are going higher. You haven't seen the end of the movie. You will be the victim. You will lose everything. You will spend the rest of your life just trying to get back to even. And the paranoid that you made fun of, they're the ones who are going to inherit everything. They're the ones who are going to scoop up all of these assets at pennies on the dollar in preparation for the next bubble. And AI will not save you either. What AI will do is make sure that you're never going to get your job back. Don't say you haven't been warned. With that, folks, let's expand the conversation here and move on to the coverage of the stock market. We begin with the closing of the indices last Friday, and here we go. The diamonds in the red, down by 118.04 points, or a decline of 0.31%. The Nasdaq barely positive by 2.57 point, or a gain of 0.02%. The same goes for the Spider, up by 3.59 points, or a gain of 0.08%. The Russell 2000 down in the red by 0.32 points, or a loss of 0.17%. Looking at these sectors on Friday, we see that energy at number 1. Due to the fear of geopolitics and what's going on in the Red Sea, we have real estate rebounding at number 2. Number 3, utilities. We have seen rates going down on Friday, just a tick, but it was good enough for these rate-sensitive sectors of the market. The laggards are led by consumer cyclicals, financials, and healthcare. Now, Tesla has a big weighting in cyclicals, so when it went down on Friday's session, it dragged down the entire sector with it. We contrast all of this with the weekly performances of the sectors. What do we see here? It was the inverse of last week's theme. Last week, it was all defensive. It was all about dividends. It was all about rotation out of the winners of last year. This week, we see the opposite, going back to the winners from last year, the mega cap technology stocks. So at number 1, we see technology. Number 2, we see comm services. Number 3, defensives. That's really interesting. The staples came out at number 3, high dividends, more of a defensive theme. So we have a mixed reaction here. Perhaps positioning when it comes to the mega caps, but then real inflows is picking up staples at this point, which is defensive, not risk on. The laggards for the week, led by energy, utilities, and materials. The dollar was doing pretty good holding for the week, so that added pressure on metals, perhaps on energy throughout the week. When you look at the breadth on Friday, NYSE 50% advancing versus 48% declining. The Nasdaq 41% advancing versus 55% declining. This is exactly what the market maker wants to do. Close the market as neutral as they can before the long holiday week. So we see the NYSE almost 50-50. Now we begin a new week in a new direction. Let's move on to commodities. What do we see here, at least on Friday's session? Initially, crude oil was up almost 3%, then it went down, closing the session with gains of about 1% apiece for the WTI and Brent. And of course, it was a big week, but a big day on Friday for natural gas, up about 7.5%. Now we see natural gas, at least in the session so far, as I'm recording this video, down. And the reason is natural gas went higher in preparation of this winter storm. But this will be the last week, and after that, it will pass until the next storm. So it would not be surprising to me to see natural gas retreating this week. When it comes to softs, on Friday we see coffee down north of 2%, but cocoa remains hot with gains of over 1%. Metals, even though the dollar did not go down, but because of the geopolitical risk, we see hedging here and buying gold and silver. We see gold closing with gains of almost 1.75%, and we see silver closing with gains of almost 3% on Friday's session. But the risk-on metals, platinum, palladium, and copper were down for the session, so this says that, hey, we got to hedge here. We have a long weekend. We have no idea what's going to happen in the Red Sea and the Middle East, so we have to hedge by buying crude, gold, and silver. When we look at meats and grains down across the board on Friday's session, notable pullbacks here in corn and wheat futures, perhaps in preparation of the dollar moving higher next week. When we look at the weekly performances all in all, we see the gasoline RBOB up about 4.5%, so you're going to feel some of that in the pump. And again, it goes back, it ties up with the conversation with the CPI. If gasoline was the reason why we went down the CPI, now that we see gasoline coming back up, gaining about 4.5% in a week, that means that the CPI will move higher. And this is going to be a problem for the Fed and rate cut expectations. We'll look at crude oil, we'll look at natural gas, all up for the week, north of 2%. And that's inflationary. We move on to the big casino, the options market. What do we see here on Friday's session? The volume remains shy with the exception of a handful of names. We're talking about Tesla, we're talking about NVIDIA, and Mara, which is Marathon Digital Holdings. But you look at Apple, for example. That name used to trade 1 million plus contracts per day. On Friday, traded about 600,000 contracts. So the volume is shy here. But we see some activities in the options market in Tesla, NVIDIA, and Mara. This is, of course, related to Bitcoin. Now, when it comes to Tesla, we see that the spread right now is 50-50. So we see that folks are now buying puts. Maybe a sign that these are Johnny-come-latelys. The stock is already down big for the week. Maybe a sign that we will see a rebound coming for the souffle. NVIDIA, it's the same thing. Stock rallies big. We talked about the breakout before the year even began. Now we see the call options volume moving higher a tick. Are these folks a little too late in chasing the pop here? I think NVIDIA could go down and pull back. Tesla could rebound at least Thursday, Wednesday, and then we'll see what happens in the remainder of the week. Now, when it comes to Mara, we're going to give you an update in the charts analysis in a minute here, but before we do that, we know that the VIX is low, so we see a stampede, we see splurging right now. on cheap options hedging. And folks, when we see that, there is no point of being arrogant here. If you're sitting in a long portfolio and you're up big, you see the VIX down, you see the pricing of hedging down, take advantage of that and weather your portfolio. Buy some cheap insurance policies. If we go down in the stock market, at least you have some protection here and you can lock in some of your profits. Moving on to the unusual activities that took place on Friday's session in the options market. What do we see here? You see all of these trades for UAL. This is United Airlines. It's probably the same trader buying calls with different expiration dates. What is the message here? We got a bad report from Delta. All of these airliners went down. But the rumor right now is the FAA will look into the bolt issue for Boeing, and they will say, okay, we can resume flying these jets again, so long as you tighten the bolts a little bit here. Now, which airliner has the most exposure to these flying coffins by Boeing? The answer is United Airlines. So if the issue is just a loose bolt and the FAA is about to approve the planes again, then UAL already went down big along with Delta. The expectations are maybe a rebound coming for the name here. So we see somebody who bought, if we take an example of the 3 trades here, somebody who bought the 42 calls with the expiration date of February 2nd. Expectations, the name is going to rebound and gain more than 5.5% of its value by the expiration date. Paid about $1 a piece to enter this trade, all in all spending about $1.4 million. And then we have the trade for COIN Coinbase. The name is down big because of the phenomenon of sell the news. So we've been buying all of these names, Bitcoin, along with Coinbase and the miners in anticipation of the SEC approving the ETFs. Well, we got the approval and the reaction was sell the news. A lot of these stocks went down big, including Coinbase. Here we have somebody who was anticipating a rebound and they bought the 142 calls for the expiration date this Friday, Jan 19th. Expectations, we're going to see a rebound north of 8.5% of this name. They paid about $1.75 a piece to enter this trade, all in all spending about $2 million. Last but not least, what about CCJ Cameco? This is a uranium play. We like uranium in this channel. We've been bullish uranium, and I think that this is a name that gives you good exposure to uranium. So somebody sees the pricing going higher. They bought the 55 calls for the expiration date Feb 16, with expectations that Cameco will gain more than 10% by then. Paid about $1.30 a piece to enter this trade, all in all spending about $1.3 million. Moving on to the heat map, what do we see in the heat map for Friday? We see that rotation, the big caps, still going on as of Friday's session. So we see the winners, Microsoft and Meta. Marginal gains for Google and Apple. We saw NVIDIA pulling back a tick here, even though it's a major winner for the week. The banks, of course, we got earnings from JP Morgan, Citibank, Wells Fargo, Bank of America. We see mixed reactions here. JP Morgan was a gap and crap. Wells was a disaster, down over 3%. Then you got BAC, Bank of America, that's down also, and the results are not really that good for Bank of America. The same goes for Citibank. Awful results. But because they announced the news of laying off 20,000 employees, investors of course loved it. And we see the stock, in contrast to JPM, Wells Fargo, and Bank of America, actually trading higher. In healthcare, we see the Ozempic mania still hot, Eli Lilly, NVO, even Amgen, which could be an Ozempic play really soon. But we see pullbacks here in the healthcare providers, led by UNH, was down a little over 3.25%. So we have some money coming out of that name. In industrials, again, the geopolitics is predominant right now. So we see the defense contractors, Raytheon, GD, General Dynamics, Lockheed Martin, Northrop, NRC, all moving higher. Boeing, which I don't really consider as a pure defense contractor, has its own problems, so it is down yet again about 2.25%. You see the block of the airliners all down on Friday's session based on the earnings guidance that we got from Delta. And again, the geopolitics remains hot, so we look at materials. We see gold. All of the gold miners are up. The exception, of course, the drag down came from Newmount. Newmount has its own problems, but the rest of the miners are doing okay. Then you have hedging via buying energy. So we see Exxon, Chevron, the refiners, VLO, MPC, decent week for the gasoline RBOB, which is good for these refiners. The defensives gained a little bit, Coca-Cola, PepsiCo, Costco, but nothing notable here. We have seen steep losses in cyclicals, as we talked about the souffle, Tesla down yet another 3.5% plus on Friday's session. dragging down the auto part companies, other manufacturers all down, store stocks, apparel, restaurants, traveling services, all down for the session. In comm services, we see rebounds in Verizon, AT&T, the high dividend names. But of course, we're going to get retail sales this week, and if it comes out hot, we could see a rebound in bond yields, which will push all of these dividend-paying names like Verizon, AT&T down, and cause a rebound in the cyclical side. The retailers, apparel, resorts, hotels, those could come back in a rebound depending on the number that we're about to get from retail sales. Let's contrast the theme with the weekly theme here. What do we see? It was all about the remigration back into the big caps. Huge gains for Microsoft, Google, Meta, Amazon. Of course, Apple, the laggard, but still gaining and rebounding about 2.5% plus. And of course, huge week for Nvidia, up about 11.5%. We've also seen other technology names, software such as Salesforce, ServiceNow, Uber, Adobe. It's been hot for the cybersecurity names, Palo Alto, CrowdStrike, and they added to the gains this week. Absent from the Mag 7, and folks, I made it clear that it should not be included in the Mag 7. Tesla, huge down week. Lost almost 8% of its value. And we have a problem here with this company. Margins are down. Supply is going higher, which will add more pressure on margins. You have the blockage in the Red Sea now, delaying manufacturing in Berlin. All of these problems caused the souffle to be down about 8%. We look at banks, down across the board. The exception is the companies that benefit as the consumer continues to spend and rates stick higher. The credit card companies, Visa and MasterCard. On the other hand, you look at AXP, Amex. Why is that down? We talked about the affluent consumer pulling back on spending. This is why we see American Express down. But Visa, MasterCard, the regular folks, the poories, the middle class, they have to cope with this inflation and the rising costs by swiping the credit cards up and down, up and down. So that's good for Visa, MasterCard for now. We see rebounds in the insurance companies. Those remain hot. Insurance is a scam right now. They can charge whatever they want. So you see dips in names such as PGR, Progressive, being bought all the time. If you look at healthcare, remains hot. Ozempic mania still here. Eli Lilly. Biotech was hot, although we've seen some pullbacks in some biotech names such as Moderna. Some money coming out of the insurance names, UNH, Cigna. Where's the money flowing to? The answer is medical devices, they remain hot. Abbott, Medtronic. We have SYK, Stryker, that continues to be hot. We looked at the chart over and over in the live streams, and it looks pretty good for now. The instruments, ICRG, that's also hot, gained big this week. When it comes to the industrials, which are really sensitive to the dollar going up or down, the dollar was flattish for the week, so we see mixed reactions, but Boeing, of course, has a huge weighting in the ETF, the XLI. And no surprise here, was down over 12.5% for the week, dragging down the entire index with it. Now, yields did not do much either. We're talking about bond yields, but it was a risk-on week, not a risk-off, so we see utilities down in the red. We see real estate mixed. Utilities, of course, being the defensive yield-sensitive, while we have real estate as the risk-on yield-sensitive. And this week was risk-on, not risk-off. Mixed bag here in materials. You see NEM, New Mount, Gold Miner had a lot of problems, but the rest of gold miners are doing okay. Same goes for energy. The refiners, MPC, Valero, did pretty good. Rest of energy stocks were down for the week. The defensives caught a bid, so we see names such as STZ, that moved higher. Names such as Costco with a rebound worth about 4%, Walmart, Procter & Gamble. Of course, the weak link now is PepsiCo. And the reason is we have some supermarkets, at least in Europe, kicking them out because their prices are too high. So the question now becomes, is PepsiCo losing their pricing power? Looking at cyclicals, what do we see here? Big rebounds in Home Depot, Lowe's, perhaps with mortgage rates going down. Folks are betting that we will see at least some demand for Home Depot, some repairs going on, updates in the homes, in preparation to dump them in the market. That's what the assumption says right now. We'll see what reality says later on. Auto manufacturers, we talked about Tesla being a problem, GM, Ford, all down for the week. But we see Toyota up about 4.5% for the week. The reason is the yen is down. And the Nikkei is surging higher, the Japanese stock market. So Toyota is the outperformer here. Talked about Amazon, talked about Meta and comm services. You got Netflix, decent week, cutting costs. So we see that the name moving higher. Bad week for the winners of last week, Verizon, AT&T. Those are down 4% for Verizon, over 5.5% for AT&T. All in all, the rotation from the defensives back into the big caps again. You look at the year-to-date performance for the map here. Nothing happened. Most of the market is flattish to down, with the winners being Nvidia, Meta, the Ozempic mania, and Eli Lilly. Some of the healthcare names are doing pretty good, but the losers, led by Boeing, Tesla, a lot of the other chip names and the banks were down. But all in all, the market is flattish. Nothing happened so far this year. Looking at the weekly performances for the ETFs here, the heat map, what do we see? Looking at the TLT and the TMF, bond yields did not do much. So it was pretty much depending on what the inflows and outflows are. And the inflows this week were chasing large cap growth. So we see the IWF, VUG outperforming the rest. Outperforming value, mid cap, small caps. So it was a decent week for the XLK big cap technology stocks. And of course, NVIDIA led the SMH. This is the chips ETF higher for the week. It was not a good week for regional banks, KRE, or for energy, XLE, XOP, but it was a decent week for URA, uranium, and definitely a decent week for UNG, natural gas. I'm not sure if that's going to be sustained or not, as, of course, the worst of the storm will be behind us after tomorrow. Then we'll look at internationals. Chinese equities down, even though the dollar did not move by a lot. But we see the EWJ, Japan, up big, over 4.5% in 1 week alone. The outflows out of Chinese equities continue, and they're now chasing Indian and Japanese equities. So you see the INDA, the India ETF, also finishing the week positive by almost 2%. Now, all in all, you look at the heat map for the year so far, and nothing really is going on here. We're flattish. So we haven't established a theme yet. And that's the challenge, so long as we continue to search for what will the Fed do next, depending on the data. Let's move on and do some charts and then wrap it up. We begin with the SPY, an hourly chart. What do we see here? Last week, we talked about the possibility of a falling wedge here, and we could see a breakout. We got a breakout. We're now back at the highs again from last year, but the chart is having a hard time passing above. On Friday, it formed a pullback in a bear flag pattern. If this plays out, we could retrace some of the gains from last week. And if that happens, we have strong support in or around 473. That is a critical number, because if we lose 473, then there is a high probability we'll be down to 468 really soon and erase the entirety of the gains from last week. Now, we'll take the bear flag with a grain of salt, and the reason is we had some de-risking ahead of the long holiday week. It was low volume. But the confirmation for the bear flag is losing 475. Looking at the daily chart for the SPY, what do we see here? We talked about the easier path before the CPI, just finish the move to the downside, get us to the lower Bollinger Bands, get us really oversold, then we're going to get a rebound after the CPI. We took the harder path instead, which is rebounding ahead of the CPI. And then after the CPI and the PPI came out, we're kind of not sure here what to do. Got a retest of the 20 days moving average and closed at the highs. So for now, we have to assume that the path is higher, absent of losing the 20 days moving average again in white. And look at the vortex indicator. If we expand that a little bit, you see the blue line is advancing here. So the bullish outlook is gaining the advantage over the bearish outlook. That higher we go, at least for now. We go back to the chart again. What's up with the MACD though? Why is the MACD continue to trend negative despite the rebound that we got this week? The answer to that is the MACD is more sensitive to the volume than the vortex. And throughout the rebound, it was led by weak and declining volume. So the MACD right now says that whatever rebound we got, it is really weak. It is on shaky ground because there was no volume behind it. What do you do in this case? So long as we're above the 20. You got to go with the vortex, but keep in mind that the MACD is warning us here that the rebound was weak and it could be erased really fast. And once we lose the 20 days moving average, then we have a short trade again. If we look at the E-mini futures, an hourly chart, what do we see here? We talked about the importance of 4,772. And by the way, that was before any reaction we got from that line. We identified that before the 9th, that it is an important line, and we don't have a reversal of the rebound until we lose this line. You can see that it held pretty good twice. So in your assumption right now, you got no reversal and no short trade against the rebound here until we lose the 20 days moving average in the SPY and until we lose 4,772 in the E-mini futures. Looking at the daily chart, what do we see here? We're stuck. We're not doing a lot. We got a rebound off 4,700, which is really strong support for now and a critical number, because if we lose that line, then it's over. We got a top here, but we're going to have more losses to come. We're probably not going to see the highs that we're seeing right now if we lose 4,700. Even if all the fears are gone and we have rate cuts, we're not going to see them for a while, maybe until we get to the summer. And that's the bullish outlook. So it is an important number. It is a critical support to be kept by the bulls. Now, what do we see the chart saying here? You can argue for a bull flag consolidation pattern and the energy to be released to the upside. We expand the vortex indicator in the E-mini futures. What do we see here? The predominant momentum, at least at the moment right now, is the blue line, aka the bullish, but it is losing steam. we see the red line firming up. So if this plays out, probably the bears will regain momentum and erase the gains that we got from the week. You look at the weekly chart for the E-mini futures, what do we do here? Again, it's not the easiest trading setup because we've been consolidating here. We went down a week, we went up a week, and now we have to wait for what will be the move. Is it going to be a break to the upside? We go back to the upper Bollinger Bands at 3%. That should be the base assumption for now. Absent of what? Absent of losing 4,700. We lose 4,700. Then we have to assume that we have a pullback all the way down to the 20 weeks moving average. That will be in or around 4,500. Looking at the Qs and hourly chart, what do we see here? Talked about the saucer bottoming formation last week and the possibility of moving higher. Indeed, we moved higher. And now what? We got back to the highs. We closed all of the gaps above. We got a little bit of a pullback Friday, forming a bear flag pattern. I'm going to take that with a grain of salt because of the low volume and the de-risking heading into the long holiday weekend. Confirmation for a reversal in progress that we got for the week is the loss of the line 404.5. Looking at the daily chart for the Qs, what do we see here? We got a rebound this week. We're above the 20. Done a retest of the 20. We are still trading above. So the assumption should be, going with the Vortex indicator, that the bullish momentum is predominant and increasing. The problem goes back to the MACD. Why is the MACD still trending negative? A, it's lagging. B, it is volume sensitive. And the rebound came on low volume. But again, you cannot really say that down we go again until we lose the 20 days moving average in or around 406. Daily chart for the NASDAQ futures, what do we see here? Once again, we're above the 20, so for now until we lose the 20, and I would say losing 16,767.5 would be a confirmation. You gotta go with the assumption that higher we go, until proven otherwise. Better yet, when we're stuck within a range, you're better off not trading here. You're better off waiting for a break one way or the other. If we break above 17,165.25, you gotta assume that we have more upside to come. If we lose 16,767.5, you gotta assume that we made a lower high or we have more downside to come. Look at the Vortex indicator. It's a battlefield. There is no definitive answer right here. It's easier to trade when you have a clear setup, up or down. Harder to trade when you have a battlefield in front of you. The IWM small caps daily chart, what do we see here? Below the 20, so this is more negative than the SPY and the Qs. Is it lagging? And it is the opportunity to catch up with the SPY and the Qs, or is it the leading indicator that the S&P and the NASDAQ will be dragged down with it? You got to understand the IWM is more rate sensitive than the SPY or the Qs. So for now, as we've seen a rebound, at least a tiny bit, in bond yields, the IWM small caps with a lot of zombie companies is upset. It is holding the support of the gap in or around 193.5. If that's broken, and there is a high possibility it could, then down we go to the zone I'm highlighting here, below the Bollinger Bands, which would be in or around 185. Now breaking above the 20 days moving average, then indeed, we have a catch-up play here where the IWM is going to catch up with the SPY and the Qs, and that would be the opportunity. Looking at the weekly chart, what do we see here? Got really excessive to the upper Bollinger Bands in the weekly chart, print in a reversal candle. Indeed, we got a reversal. Now, this week we have an indecision candle, also known as a doji. Following a doji, usually we have a big move one way or the other. This could be just a retreat, and then higher it goes in a big way. Or it could be a big flush down to the 20 weeks moving average. So what do we have to look for? We have to look for retail sales. Retail sales will have an impact on bond yields. And if retail sales come out hot, we have indicators that that could be the case. Looking at the credit increase in December with folks using and utilizing credit cards. If retail sales numbers come out as a blowout, we see rates moving higher again in bond yields, then the IWM will make it down to the 20 weeks moving average. That will be in or around 182. If retail sales come out soft, but not too soft, as indicating a recession, then we go back to rate cut expectations, and we see bond yields going down, and the IWM popping higher and reaching the upper Bollinger Bands again. What about the dollar? What do we see here? Holding above the 20 days moving average, consolidating for now, appears to be bullish, to me at least. Waiting a breakout, maybe retail sales will do the job here. But so far, it's not upsetting the old man gold. The old man is actually above the 20 days moving average. Went down to the lower Bollinger Bands, now got a rebound, so what's up with that here? Is the old man saying, watch out, the dollar will go down? That's a possibility. The other possibility is, if we switch to a line chart, you got gold in green, and you got the dollar in orange here. We should have switched the colors, but anyways, we can see that we have instances where gold outperforms despite the fact that the dollar is trending higher. Why do we see that? Hedging against geopolitics. So you can see since October 7, Gold has been trending higher, with higher highs and higher lows. And recently, the dollar and gold been moving higher together. Dollar is moving higher because we're anticipating the rate cuts will not happen by March, given the CPI. But gold is also moving higher as a hedge against the flaring geopolitics. You look at the GDX gold miners daily chart. Got a breakout off the falling wedge, reaching the lower Bollinger Bands. This was an easy trade. Now it becomes a little harder. We got to 29.77. Couldn't really close above, but it's not a big deal here. If we continue to move higher, as we see gold prices moving higher, the assumption is NEM will be bought again and gold miners will recover, reaching above the 20 days moving average. The same can be said with silver. Got to the lower Bollinger Bands, formed a falling wedge pattern, got the breakout short of the 20. But all we need is just a pop in the commodity price. Dollar or no dollar, so long as we see demand based on the geopolitics, it's going to make it above the 20 days moving average. Now, if investors reassess after a long weekend, they say, you know what, the geopolitics right now are stable. We bombed Yemen and nothing happened so far. Then we could see a pullback in oil, gold, and silver. So the assessment will become really important here. My take, if that happens and we see a pullback, that would be a buying opportunity. And the reason is you cannot really assume that we're out of the woods when it comes to the geopolitics. We look at Brent oil. What do we see here? Friday session got to the top of the Bollinger Bands, then pulled back, closed above the 20 days moving average. As I'm recording the video right now, we're trading a little below the 20 days moving average. It becomes really hard looking at the daily chart to assess which way to go. Tailwinds, geopolitics, headwinds, the supply problem. We look at the weekly chart. Can we make an argument here that maybe this is a bear flag pattern and down we go in oil? You can make that argument. And again, it depends on the data. More recessionary data, more weak data from China means that we have the headwind winning here. Problem is we can make a case that this could be also a bottoming formation. In a double bottom, triple bottom, doesn't matter. We found some support here before. And if the geopolitics becomes really a headache for investors, and we look for hedging, we could see the chart rebounding and moving higher from this point on. So again, the question now becomes, when you hedge against the geopolitics, do you want to go with the volatility of oil? It is the highest risk, highest reward option, but you have other options. You have stable options like gold. You have defense contractors that you can consider too. When we look at the 10-year yield, what do we see here in the daily chart? It is the battle of the averages. Support at the 20 MA, resistance at the 200. Break above, we have a big pop higher coming for bond yields, and the equities market will flush down big. Break below the 20 days moving average means that yields are going down, and equities will probably love it. And I think that retail sales will seal the deal this week. We'll look at rate-sensitive charts. XHB daily chart, what do we see here? We got a pullback on Friday, closing below the 20 days moving average, but I don't want to short this one here until I get a confirmation that yields are going higher, until I see a break below 91.45. Then we unlock more downside to come in this chart. We look at the IYR, real estate. It's a lot weaker than the home builders. It is below the 20 days moving average. It went down in a retest of the lower Bollinger Bands, caught a rebound, then caught the resistance of the 20 days moving average, and it's now just yo-yoing back and forth. If Friday was a rejection of the 20, then down we go to the lower end of this channel, in or around 88 or below. But the big move not coming until after retail sales. XBI Biotech, I still love the sector here, but you have to be picky. And sometimes maybe it went way too high too fast. What we see is a retest, filling the gap, and then a failure, which is bearish, not bullish. If we see that retail sales pushing bond yields higher, then the XBI will lose the 20 days moving average. And maybe find some support at the low 80s. The message here is if you're long XBI, you gotta have some good hedging plan. The XLU utilities, what do we see here? Daily chart, again, rate sensitive, not looking pretty good here. It lost the 20. Got a big rejection candle on Thursday. On Friday, we got a confirmation below the 20 days moving average. Unless we get defensive here, XLU will not shine. And then you have the KRE, which is risk on, yield sensitive, regional banks. Not a good closing here on Friday. Made a retest to 51.38, couldn't really close above it, and closed at the lows. Caught some rebound, some support from the lower Bollinger Bands. But if yields continue to go higher, then the KRE will lose the lower Bollinger Bands of support because it's going to expand to the downside. Then we have to look down at 47.5. Looking at the banks, JPM, big gap and crap here, got to the top of the Bollinger Bands, above 173.35, and then closed below, almost. At the 20 days moving average worth of support here, we have a bearish trade on JPM, and I would say we have to stick with it here. maybe extend it a little bit because this reaction was bearish. It was not a good reaction. Same goes for BAC. We got a bearish trade on it. I think it already played to the target. And then we talked in the morning brief on Friday for the possibility for a rebound in or around 32.13. We got the rebound, got us above the Bollinger Bands, but we closed below. So again, a loss of 32.13 will be confirmation that we have more downside to come in BAC. The VIX daily chart, what do we do here? Falling wedge, got a breakout on Friday, maybe the beginning of the demand, as we just covered in the options market coverage. Demand for the VIX, demand for hedging, cheap hedging could push the VIX higher here. But it got to go above 14.13, close the week above to initiate and unlock more upside to come. Apple, Big Kahuna, daily chart, what do we do here? We caught support from the 200, not the 200 days moving average. Now we're in purgatory, really. Can you short Apple again? If we lose 183.5, I guess, you can go all the way down to the 200 days moving average, in or around 180.5. But the big short will not happen until we lose the 200 days moving average. Then the algos will be on your side, also dumping Apple along with you. But the risk here to the upside is if we plug in the Bollinger Bands and the 20 days moving average, that the chart could do a move all the way to the 20 at around 190, if not even close the gap altogether. So there is still risk to the upside in a continuation of the rebound here. You look at the weekly chart for Apple, which way does it lean? It leans bearish or above the 20 weeks moving average again, but we're losing a lot of momentum. I would say you need to see another loss of the 20 weeks moving average at around 183.33 to get a confirmation that we're not going to fill the gap, and down we go to the lower Bollinger Bands with a loss of about 10.5% from this point on. Otherwise, you can go up, close the gap with gains of about 3.70%, and then we see what happens. So for now, still no confirmation one way or the other. You actually got to assume that the chart will close the gap because it closed above the 20 weeks moving average. If it loses it again, then we got to trade to the downside. Microsoft, daily chart. We talked about the energy release. You look at the momentum indicators, RSI, MACD, Vortex, all positive here. So we got to break above 376. We got to break above the previous highs at 384.30. So long as we trade above, we have more juice to squeeze to the upside here. If we lose 384.30, then we're going to get a pullback. But again, all in all, the chart remains positive. Tesla, Souffle, what do we see here? Daily chart. Number one, we lost the 200 days moving average, and that's bearish, now bullish. With that being said, number two, we're at the lower Bollinger Bands, so we're getting a little oversold here, even looking at the RSI. Can we see a rebound here? The answer is possible. If we erase all of these indicators and use the lines that we have, support and resistance, we also have support at 217. So we can make a case here of Tesla rebounding all the way to the 200 days moving average if it is met with rejection again. Then we have more downside to come. But what if the souffle just decides to go way oversold, unlock more downside ahead of the report that's coming out soon? For that, we'll look at the weekly chart. We lost the 20 weeks moving average, and we have support at the lower Bollinger Bands. That would be in or around 205.5. That would be a loss from this point on, worth about 6% or so. But the bottom line is, if you see Tesla down again, 5-6%, it's probably going to get really, really oversold. And you got to play a rebound at that point. Now, are they going to make it that easy to get it really oversold in the daily and the weekly, and then it becomes a no-brainer to bet for a rebound ahead of the report coming out? I don't think so. I think what they're going to do is rebound it ahead of time, retouch the 200, and then take it from there. If there's a rejection, then we have more downside to come. I think if you happen to be on the bearish side for Tesla, you don't want to head to the report being really oversold. You want to see a rebound, catch in some buyers, trap them in, then the report comes out and unlock more downside to come. BA Boeing, daily chart, what do we do here? We got the big drop, and if you happen to be in my Discord, we got a trade on it. It was a really handsome trade here with a lot of profits, but we had to close it because we got expiration date of Jan 19th, so not enough time here. But if you have a longer trade, with the expiration date, you can stretch it all the way down to 212.88, and then you're going to find strong support. So you have a little bit of juice here to the downside, but you got to be careful. The move is pretty much coming to an end. My expectations are there is a rebound coming soon. If we look at NVDA and NVIDIA daily chart, what do we see here? We talked about the inverse head and shoulder, the breakout. We got the breakout. Now we're getting really overstretched here. The RSI is overbought. We're above the daily Bollinger Band, so we're not be surprised here if I get a pullback, let's say to 530, 525. But ultimately, you look at the weekly chart. Sure, we got a little overbought here outside of the upper Bollinger Bands, but any pullback will be bought, at least for now. And the reason is, you look at the momentum indicators, they're all positive. Vortex, RSI, MACD, now changing back to positive. And again, I'm a NVIDIA bear, but the chart looks good. The momentum is still here, so you got to assume that the momentum will continue. And we have all of this energy release happening right now. It's going to run into a wall, but that wall is not going to come until we see earnings becoming front and center. Same goes for AMD. We see in the weekly chart here, got really overbought, we got a correction, then we got overbought again, reaching the upper Bollinger Band. So what do we do here? The message from the chart is we pretty much reached the top of the gains here, at least for now. We need to pull back more to find the energy to unlock more upside. Now, if you happen to be an AMD shareholder, what I would do is selling the 150 calls, covered calls, with the expiration date of Jan 26. Then buying the 143 puts. It will cost you all in all about $9 here. So it's a cheap insurance policy if there is more downside to come for AMD. But you got to make sure that you're okay with dumping your shares at 150, because if we trade above 150, your obligation is to sell at 150. Now, to me, it's not a problem because you can sell it and buy it back again. But for now, after a clear rejection pattern here, the upside is limited, at least for now. You got to have some good hedging strategy. Looking at tulips, Bitcoin, what do we see here? Sell the news. We got below the 20 days moving average, but not major damage. I don't see any major damage here. We can talk about that if we lose 40,000. Most importantly, 38,000. For now, it's sell the news. Buyers could step in again. But the buyers are being distracted right now, looking for the next big move in cryptos. So you see Ethereum outperforming Bitcoin. You have the shitcoins now gaining steam over Bitcoin. And this is why we see the chart a little weaker. But again, no more downside coming until we lose 38,000. It begins with 40,000. For now, it's just consolidating within a range. But the damage has been done for the miners and those stocks that are branded ahead of time in anticipation of the ETF approval. So you look at Mara, it played out the inverse ABC pattern. It could finish it all the way down at 17, 16-ish, and then find support. But these are really volatile names. And the dip buyers will come out and at least attempt to get it back above the 20 days moving average. For now, the downside is the predominant move, but I would not be surprised to see dip buyers showing up. If they do, and we have a rejection off the 20 days moving average again, then that will be a shorting signal all the way down to the support that we will find in or around 16-ish. Then we'll look at COIN Coinbase. What do we see here? Talked about the retest of the 20 and the failure, big bearish engulfing candle. Now, in Friday's session, we've done a retest filling the gap. That was a no-go, and the chart closed at the lows of the day. Losing the gap, losing 134.33, which is a previous support line, and losing the lower Bollinger Bands. Now, we can expand the Bollinger Bands to the downside, and we see more losses to come. And this is the consensus for now, absent of recapturing 134.33 and closing above by the end of the day. Moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, today we got nothing. Happy MLK Day. Tomorrow, Tuesday, Jan 16, we have the Empire State Manufacturing Survey. We have another zombie from the Fed, Governor Waller, speaking. Who cares? Wednesday, the 17th, perhaps the most important day of the week, we have the import price index, then we have the most important retail sales, then we have a bunch of Fed zombies, from New York Fed President John Williams, the Vice Chair Micah Barr, the Governor Bowman, all speaking. But we also have industrial production along with capacity utilization, comes on top of business inventories, and again, an important indicator, the Fed Beige Book. Thursday, the 18th, we have the zombie from Atlanta, Bostic, speaking. And then we have initial jobless claims, the Philly Fed Manufacturing Survey. And two important indicators here, housing starts and building permits. Lastly, Friday, the 19th, consumer sentiment, really important, comes on top of another important indicator, existing home sales. We just talked about the housing market, so this is going to be really important. Do we have demand coming back in or not? Then we have the comeback, Vice Chair Michael Barr speaking again, and from San Francisco, another zombie, Mary Daly. With that, folks, this is all I got for you for tonight. And if you found this video informative and you like the video, show that by pressing the like button, subscribe, and consider pressing the join button and becoming a Maverick member. And the last thing is, folks, I've been sick since Friday, so I owe you the portfolio strategy video for the members. I'm finishing that right now. It might not come out tonight, but it's going to come out tomorrow at the most. So apologies for the slow pace. But once again, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
This may be an opportunity,
This may be a trap.
if you play the odds.